You don't need a six-figure salary, a fancy degree, or a crystal ball to build wealth. What you need are small, smart choices, repeated. Today I'll show you how real people, and some of the smartest investors in history, turned ordinary decisions into extraordinary outcomes. This is not about luck. It's about systems, mindset, and habits. First, the hard truth. The modern economy is noisy. Headlines scream about inflation, interest rates, layoffs, bull markets, bear markets. That noise can hijack your choices. But underneath the headlines are two permanent truths. Time is the investor's greatest ally. Simplicity and discipline beat complexity most of the time. Warren Buffett, one of the most famous investors ever, built his fortune not by timing the market, but by buying good businesses and holding them. John Bogle, the founder of Vanguard, transformed investing with one simple idea: low-cost index funds and long-term discipline. Ray Dalio popularized the idea of diversification and risk parity, that different assets behave differently in different environments, and you should balance for that. Those aren't just names. Those are repeatable lessons. You don't need to be them to use what they taught. Okay, let's map a practical plan. The kind you can start tonight. No jargon, no get-rich-quick nonsense. Step 1. Safety first. An emergency fund. Step 2. Control your expenses and define your goals. Step 3. Invest consistently with a simple, diversified plan. Step 1. Build an emergency fund. 3 to 6 months of living expenses, or more if your job is volatile. Why? Because you don't want to sell investments at a loss to pay an urgent bill. Volatility should be an opportunity for investing, not an emergency. Step 2. Control what you can control. Track your spending for a month. Identify 1 or 2 things you can realistically cut back on. Redirect that money to investments. The goal isn't deprivation, it's choice. Add a clear goal: buying a home, travel, early retirement, or simply financial peace. Step 3. The simplest strategy that works. Regular contributions to diversified, low-cost funds. That can be a broad stock index, a simple target date fund, or a mix of stocks and bonds that matches your timeline. Why regular contributions? Because of a powerful but quiet force called dollar cost averaging. When prices are high, you buy fewer shares. When prices fall, you buy more. Over decades, this smooths out emotional errors. You don't need to guess the market's top or bottom. Money is emotional. Shame, fear, greed. They show up in our decisions. The market will test you. 2 moments define most investors' outcomes. When the market is soaring, will you stay humble? When the market is crashing, will you panic? Remember 2008 and 2020? Those were real tests. People who panicked and exited at the lows locked in huge losses. People who stayed invested, or better yet, bought more at distressed prices, were rewarded when recovery came. History doesn't promise future returns, but it repeatedly shows markets recover and grow over long horizons. So build a plan that matches your temperament. If you know you'd panic in a 40% drop, reduce equity exposure. The best plan is the one you can stick with. Let's walk through 3 real, powerful examples: the famous, the institutional, and the everyday person. The famous, Warren Buffett. Warren's story is about patience, selection, and frugality. He bought businesses he understood, like Coke and See's Candies, and held them for decades. His wealth compounded because of time and the power of reinvesting earnings. The headline: buy quality, hold long, ignore short-term noise. The investor revolution: John Bogle and indexing. John Bogle invented the modern index fund as a way to give investors broad exposure at rock-bottom cost. He showed that over time, minimizing fees and taxes often beats trying to outsmart the market. The everyday: a composite case study. Maya. Maya is not famous. She's a composite of many people I've coached. In her 30s, working a modest salary, she started with $200 a month, invested into a low-cost S&P 500 index fund and a diversified bond fund. She automated the process. Over 20 years, with raises and occasional increased contributions, she never missed a month. She had emergency savings, a bit of side income, and a conservative plan for withdrawal. When the pandemic hit in 2020 and markets dipped, she didn't panic. She invested more. 2 decades later, she had a nest egg that allowed her to change careers, start a passion project, and sleep at night. That outcome wasn't magic. It was patience, discipline, and compounding. Maya's story proves a point. You don't need a multi-million-dollar starting point to get to financial freedom. You need time, consistency, and the courage to stay the course. If you've got a handle on the basics, here are practical upgrades. Still realistic and grounded. Tax efficiency. Use tax-advantaged accounts where possible. Retirement accounts, employer matches. Pay attention to tax drag. Taxes can silently erode returns. Rebalancing. Once or twice a year, bring your portfolio back to target allocation. This forces a sell high, buy low discipline. Diversification across asset types. Stocks, bonds, real estate, REITs or direct, and cash. For most people, a simple mix like 70-30 or 60-40, depending on age and risk, works well. For those wary of inflation, adding real assets, some real estate or inflation-protected securities, can help. Don't ignore debt. High-interest consumer debt should be handled before heavy-risk investing. But low-rate mortgage or student loans might be a lower priority. Assess objectively. Invest in skills and income growth. The best asset is your ability to earn. Upskilling, certifications, or side businesses compound too. The goal isn't to chase every fancy new asset. The goal is to build optionality. The ability to choose how you live, not be forced by money. How to start today. If you're watching this and want to start tonight, here's a 5-minute action plan. Open a spreadsheet or a notes app. Write one financial goal, 1 sentence. Example: buy a home in 5 years, or retire comfortably at age 65. Find out your net monthly savings potential. Look at last month's bank inflows and outflows. Pick a realistic amount you can start with. Even $50 works. Open or log into your investment account. If you don't have one, set up a low-cost brokerage or retirement account. Consider an automated robo-advisor or a target date fund if you prefer hands-off. Automate the transfer monthly. Set it and forget it. If your employer offers a retirement match, make sure you contribute at least to the match. Build a 3-month emergency buffer if you don't have one. After that, prioritize investing. 5 minutes, that's all. The rest is discipline. Life happens. A job loss, a medical emergency, markets crash, plans derail. This is where resilience matters. When this happens, don't make permanent decisions out of panic. Reassess goals and timelines. Communicate with loved ones. Consider a temporary pause on new contributions, not a permanent withdrawal. Financial resilience is not just numbers. It's plans, relationships, creativity, and the ability to adapt. Why this works? Investing is the art of letting your money work while you live your life. The math is simple. Even modest returns compound dramatically over time. A consistent contribution of $200 a month at an average 7% return grows to roughly $200K in 20 years. Add a decade, and the growth accelerates. That's the miracle of compounding. Small seeds, planted early, grow into mighty trees. But there's a second miracle: behavior. Most people sabotage their returns by buying high and selling low. The truly wealthy don't do that. They design systems that keep them investing even when fears are loud. Practical myths and honest advice. Myth: you need perfect timing. Reality: time in market beats timing the market. Myth: stocks are only for the rich. Reality: fractional shares and index funds let anyone start with pocket change. Myth: risk equals fear. Reality: risk is measurable and manageable through allocation, diversification, and planning. Myth: you'll be wealthy fast if you find the right stock. Reality: fast wealth stories are outliers. Most lasting wealth is built slowly, deliberately. This is not just about money, it's about dignity. Having the freedom to say yes to an opportunity and no when something isn't right. It's about being able to care for someone without there always being panic in the background. For most people, wealth means options and calm. If you're thinking it's too late, it's not. If you're thinking you need more, you don't. Time is still on your side if you start today. The person you'll be 5 years from now depends on what you do today. Start tonight. Open that account. Automate that monthly deposit. Read one book about index funds or behavioral finance. Talk to someone who has done it. Build your safety net. Then let compounding do the quiet, powerful work. Wealth isn't a secret, and it's not a sprint. It's a path built by small choices, one day at a time. Make today count. If today's message sparked something in you, even just a small shift, don't let it fade. Hit subscribe and join a community of people who are building their future one smart choice at a time. Every week, we share the tools, the mindset, and the real stories that turn financial stress into financial freedom. Your journey doesn't have to be lonely. Subscribe now, and let's rise together.